give us a 1-minute rundown of, about your journey from New York to Prince Street Capital, investing into the DSE, and then, very shortly how you started to, look into the Bangladesh market and why Bangladesh?
Sure. So I left when I was about 8 years old. I grew up in the US with my uncle, and somehow ended up in New York, where I ended up at a hedge fund out of college. And what was interesting about that is one of the reasons I went to the hedge fund is because it focused on developing markets, so emerging and frontier markets. And I'd always been, very interested in how we could potentially bring it back to Bangladesh in some capacity, because I think for a lot of us, especially from that era, when we go to the West, we remember what Bangladesh was like back then, which is a disconnect very much from what Bangladesh is now. But over time, we also, I think, realized that we have a certain privilege and access that allows us to significantly help the country via making one phone call or dropping one email. And that's happened several times. For instance, when I got an email from Fahim Saleh in 2016 asking about investing in Batao. I had known my ex-boss at my old hedge fund had previously helped seed Gojek. And so I was like, hey, David, do you want to come in and look at this company? And, it was an email I sent at 1 a.m. that led to, a significant amount of the funding that Batao received early on. So, that kind of privilege is something that I've taken note of as I've gotten older. And, in 2019, after I was winding down my own startup, one of the things I realized was that I was here in Dhaka to see my parents. They live here. And I was just like, oh, let's make some angel investments with my friends, Bangladeshi American friends in New York. And met with a bunch of founders and realized that there was a gap in the market in terms of early stage funding. And went back to New York and talked to one of my partners and his investors at his fund, and they said, yeah, Bangladesh is really interesting. It's something that we would invest in. Now, I can talk about this more in a little detail, but what essentially happened was people in America, in London and in Tokyo, they're reading about Bangladesh in Financial Times and Wall Street Journal. But then they're trying to go and invest in Bangladesh, and the instruments and vehicles via which people need to actually make those investments don't exist, right? So that provided the opportunity to launch a fund where we only do Bangladesh. And so because I'm also a former, I used to construct portfolios on the hedge fund side, I know how people are constructing portfolios. So that allowed me to say, okay, you know what, I can go to somebody who has $100 million and say, look, give me $1 million in a country that has huge upside. And if it works, you can give me more, but if it doesn't, it's only 1% of your book. And I think contextualizing like that has paid off. We hopefully will be announcing the closing of our first fund soon. And, we're pretty excited about what we're doing in the ecosystem and working with organizations like Bangladesh Angels and Jawad and Nirjor. And yeah, I'm pretty excited. Today, I think, I'm happy to be here because one of the things that's very important for us is to build a pipeline and an ecosystem that we can work with and also introduce any investors that are looking into the market. One interesting note that I'll say right now, when we started investing 2 years ago, nobody wanted to co-invest with us internationally. Now, every one of our deals that we're doing in the Seed Plus round tends to be oversubscribed. That says something about the interest in the market, but what is essential to get there is we also need early or pre-seed investments to be done properly so that they are venture backable. And I think that's going to be a key part of what we discussed today.
Absolutely. I think a lot of insights to be learned. And that's why we're going to go straight to the presentation regarding why and how should angels set up portfolios for VCs. So Rahat bhai, you can take it over. You have share settings on.
Great. Does this work? It's visible?
Yep, we can see
Awesome. It. Awesome. Thank you. So just a quick overview of what Anchorless is. So we're a New York-based fund. We are the only international fund in the world that's 100% focused on Bangladeshi startups. My investors are primarily American and European. They are high net worth individuals, family offices, and a few institutions. Most of them are actually very much looking for the long-term value creation. So I know historically there's been kind of like, I don't know, I've heard this from a lot of people. It's like, oh, a venture capital, is that for like making quick money? Oh, I have a 10-year lockup, and I can extend it to 14 years, which allows me to be very, very patient because what we know from the startup market is a lot of the value is often created after year 3, after year 5, right? When the success stories happen, they grow, go exponentially. So we want to be there for our investors and our portfolio founders. We have partners based in Dhaka, New York, London, and Shanghai. Most of our backgrounds tend to be in hedge funds and private equity, not actually in early stage. But we all have experience in early stage, including myself being a former founder. And then we also have a local team in Dhaka for support and due diligence. So one of the things I wanted to start off with is kind of like the story of where angel investors fit in and the whole life cycle of a company. And this is something that I think is often misunderstood here in Bangladesh. Angel investors are supposed to come way before, you can audit financials before sometimes companies have a product. Ultimately, at the end of the day, you are investing in the people and the idea and market that they're trying to attack, right? One thing that we really believe in, actually, I'll get into that in a sec, but the details in a sec. But one thing is, at the end of the day, if you don't like the founder, if you don't want to, I mean, I don't know how else to say this. Like, if you're not going to invite, let's say you have a wedding coming up and you don't want to invite the founder, you probably don't want to invest in them. Like, it has to be family at the end of the day because these relationships go long. Exits don't happen for 5+ years quite often. The other thing is just noticing, where some of the later type capital comes in. So in Bangladesh, we have a total of $475 million raised in the history of startups, which is actually not that much money. And of that, about 400 and I think 55 or so is international. So local market is currently not really supporting the ecosystem, and that's hugely problematic because the international checks don't tend to be small. So, a lot of people need that first $25,000, $50,000 to get started. And I think there are a lot of brilliant potential founders who need that access just to get a kickstart before they're able to then go out and say, hey, I need to raise money, $500,000, $2 million, etc. Quite often, angels also come in before an MVP, right? And this is where you really have to believe in what the founder is pitching. And I'll get into a little more detail on why you are willing to take some of those bets, because this really is about getting 1 out of 5 right. 5 key things that we kind of focus on when you as an angel should be looking for the right investment, right? The quality of the founder and their focus. So Nirjo has written extensively about this. If this is a side gig, you shouldn't fund them. If a founder is working 8 to 10 hours a day, they should be focused 8 to 10 hours a day on whatever they're building, because otherwise your return rate is actually lower, right? Like, let's say somebody is working a side gig and doing this. That means you're only getting value for 5 hours of their day. That's not the kind of focus that you want. And in return, on a pure mathematical basis, you're actually getting a lower internal rate of return because they're not working to the extent of their time. Number 2, unit economics is tech-enabled scaling. There are a lot of really great businesses that should not be venture-backed. They are really just good businesses, but venture does not allow them to operate. Heavily traditional real estate, for instance, right? It doesn't move fast enough. People often ask, why is Airbnb worth more than Marriott and Hilton combined? Because Airbnb can take $1 billion and expand the market significantly, while Hilton and Marriott would be very much limited by the physical assets that they need to pay up for. Market size and potential. This one comes up all the time for me, and it's actually a very interesting timing in Bangladesh for this. It is very, very important that in a country that is this early, where our verticals are so underdeveloped, relatively speaking, that we need to focus on solving core foundational problems. There are nice to haves, but nice to haves are probably for 3 to 5 years away from now. You will really want to build something that solves foundational issues. So, probably our most focused vertical right now is fintech. Why? Without money moving throughout the economy, a lot of things just don't matter nearly as much because people aren't able to pay their work or handle their working capital properly or finance their loans, etc. Fourth is valuing the investment, and if somebody comes and says, hey, the max value of this company is $50 million and I currently value it at 10 million, that means the most you're going to get is a 5x. A 5x is too much risk in venture. right? Generally, at the seed stage, I know this is going to sound ridiculous, but we look for deals where we can get 100x. Will we get 100x? Probably not, but we want to have the potential of 100x. And finally, the exit strategy. At the end of the day, you're not going to be able to realize your investment and actually get something back if you don't have a way to have an exit. And we've got some materials for that I can share with later on that as well. But generally in Bangladesh, historically, what we've had are a combination of secondaries primarily, so people just selling shares to other people. What we ideally think is going to be the most common in Bangladesh over time is acquisitions, internationally and hopefully increasingly domestically. We have an investment in a company in Bangladesh called Shiko, which has actually acquired 2 edtech startups. That has been a pretty big deal in the sense that that has historically not happened before. And then, of course, internationally, we want to see more and more and more. One really good thing that we've seen recently is a company called Welcome, which was previously known as UseCred, just got acquired for 9 figures. I don't know if the full number has been disclosed yet. And that's exciting because the majority of the company, even though it's headquartered in New York, majority of the company's back end is actually based out of Bangladesh, sets a very good precedence. But what it really comes down to at the end of the day is you're investing in founders. Now, the easy way to explain that is if you're investing this early, you're really investing in the founder's ability to navigate the market, the product, because competition will come in, markets will change, right? The founder has to be able to actually navigate that. And, for me, I think the litmus test that I have as a fund that is in the seed and post-seed, like post-seed and Series A stage, is I ask myself, do I see the founder being able to raise capital internationally and close like larger rounds, $25-50 million rounds, right? Because at the end of the day, one thing that we have to be cognizant about is capital is globally competitive. Nobody in New York wakes up and say, "Oh, I'm going to only invest in Bangladesh." Well, apparently, except me. What is important to understand is a VC who's doing a Series A check or a Series B check is looking at companies in Indonesia and Vietnam and India and Kenya and Nigeria. So the Bangladeshi startup has to be as good, arguably, if not better. And so the risk reward has to match. So these are some of the things that have come across. I actually posted in a Facebook group with a lot of founders asking for what are the problems that you're having with angel investors. One of the main issues that we've seen is taking too much equity. And here's actually a chart historically, what happens, who takes how much equity in certain stages. One thing you'll notice, the mean is under 15%, and the median is closer to 10% at angel stage, which means, when we've seen deals where people are like, "Oh, I need to own 50%, that's not going to work." And the reason for that is very simple. You want to be able to incentivize the founder over multiple rounds of funding to have value in the company. So if somebody takes 50% at the very beginning, by the next 2 rounds, the founder has 15% of the company. It's completely possible they can just leave, build something from scratch, and actually have more value. So you do want to incentivize the founders to stick around and really continue building with you. Number 2 is taking board control. When you're very, very early stage, board control can be quite a problem, because if at the seed stage and at Series A stage, you have institutional capital coming in, which is funds like ours or other funds where we expect to not only invest in this round, but also in the round after and the round after. And then there's more investors like us coming in successive rounds. To be completely blunt, you don't want somebody to put in $20,000 and hold a board seat when other people are putting in $2 million later on. Some of the math doesn't make sense. What we have seen before, for instance, is an agreement with an angel where we say, okay, if there is X amount of money raised in a seed round by an institution, you then let go of your board seat, right? So there are ways to do this where you can have a sense of comfort, but at the end of the day, the bigger picture needs to be about successive rounds of funding. Focus on incorrect metrics. I'll dive into this a little later. That has been also a major issue. For instance, if you're looking at a pre-seed or seed company, especially pre-seed, asking for break-even profitability, or more importantly, asking for audited financials, it doesn't make any sense because they're too early. It just doesn't make sense. Even if they did audit financials, it didn't mean anything because the value that you're buying into is what they're going to do in the next 5 years rather than what they've done in the last 2. Asking for dividends, this is frankly, I think, a problem even in our public markets. In an economy like Bangladesh that's growing anywhere from 5 to 10% a year, good management or founders should be able to take $1 and create a multiple out of it. So if you're asking for cash back early, that means that you're actually limiting the company's growth, which in venture is a big no-no. In public markets, I think is still heavily problematic. Number 5, failing to add value beyond money. This is something that's going to become more and more interesting as markets get more mature in Bangladesh. We've seen instances in Bangladesh where angels will say, and a few of the founders I've worked with have given me this feedback. It's like, oh, people want X amount because they're going to do this for me. The thing is, if you're investing in the company, frankly, you should be helping regardless. Like, put the money in and help, because at the end of the day, if 5 or 10 angels come in, and then a fund comes in, the goal for everybody is to equally add value. And if everybody equally adds value, nobody else has the ability to potentially say, hey, I'm going to do a little more, because that's the whole point of giving up equity at an early stage. In the United States, where there's a mature market, term sheets or founders dominate, in terms of rounds. So the investors have to work 10 times as hard to keep their reputation and credibility, because, if you are not known for reputable, you're not going to get a deal. 3 funds will give a term sheet on day 6, and you have to be able to be the best reputable fund. And sometimes founders will take a lower value term sheet because they like the fund or the investor. We've actually had this happen with one of our startups, where we actually ended up, valuing it higher ultimately. One thing, and this is especially noticeable with angels. There's a guy who's become pretty famous, Jason Kalkanis, who's a very well-known angel. He turned, I think, $25 million or $25,000 in Uber into $100 million or so, right? And that's because he's consistently been founder friendly. He helps the founders through thick and thin, and he writes the check and then says, what can I do next, right? That's really, really important. Next, focus on physical assets. I think this is kind of self-explanatory, but with startups, who you want scalability, you want companies that are going to be able to take each individual additional dollar and get the highest return off of it. So if you're looking too much on asset value of physical assets, you're actually looking at a more traditional business. Not that there's anything wrong with that. I think it's just important to acknowledge that that type of investment is not something that you should be doing in the startup space. Not aiming high enough. This is really, really important, which I'll get to in a sec, because the goal of every startup should be to win the market. Now, even if they don't win, they want a soft landing. But if you don't go, as they say, I guess, if you don't go for the stars, you can't land on the moon. Finally, excessive tranches / not following up on commits. This is a major issue. I've seen tranches that go 3, 5, whatever. I recommend no more than 2 tranches, and ideally 1. No institution likely you will generally do more than 1. And that's because if a company starts doing really, really well, they can go raise the next round in like 3 to 6 months. So to give them milestones that may last 1.5 years can be severely hindering to them. That's something that's really, really important, because you'll see the best startups just start, especially if they start seeing product market fit, they're going to go raise as a significantly higher valuation in 6 months. We have a company in our portfolio doing that right now. And if we had given them multiple tranches, they would not be able to close, or more importantly, we wouldn't have gotten the shares that we agreed to get. So when I was talking about aim for the sky, this is kind of what I'm talking about. If you have $100,000, you want to invest in startups. The goal at the end of the day is you want 1 out of your 5 to actually, just scale crazy, right? So if you want everybody to just be, safe and give a 25% return, that's great. But that's not what startup investing is ultimately about. There are other assets that are out there, whether it's real estate or stocks, et cetera, that can offer that kind of risk reward. The whole idea of startups is, hey, look, 1 of my 5 companies, 1 out of my 10 companies is going to skyrocket. One thing that we've seen in Bangladesh that can be problematic is when an investor only invests in 1 company. And if anything goes wrong in that company, they tend to freak out a little, because it's the only investment they make. So one thing we suggest is, figure out how much money you want to allocate to startups, and then divide it up by 3, 4, 5, whatever you feel a little more comfortable. I'd say 4 minimum, frankly. And then say, okay, you know what? I'm going to put X in each. That way, the ones that work, I'm going to continue helping them. The ones that don't, it's okay, because that's money I'm kind of willing to lose there. Ultimately, if you have $1 million to allocate to everything, you can allocate 10% to startups, right? Like I think, honestly, I don't think you should go above 10% personally of your full asset base, at least until you made profit from previous startups. This is ultimately one of the riskiest asset classes. That's something that we should acknowledge. This is not supposed to be easy money, but it's money that if you've done diligent work on the founders or you're in good deals, obviously you're going to get a really good return. This goes back, I can share this in more detail later, but this is something I drafted up recently because I think what this allows is to really understand at what stage every company should be looking at, or what metrics every company should be looking at. So for instance, you can see here, you're in the, how do I have it here? So this is the angel and this is the seed. So most people who are going to be coming in are coming in this stage, which means, the MVP is already built. So first thing, one of the things I really recommend looking at is if you're talking to founders, ask them, can you build this product? Or do they need to go get people to build this product? Because if you don't have somebody who can build a product on the founding team, that's a red flag to me personally, because that means that they're at the mercy of people outside of the main team. Now, the easy solution there is, hey, you know what? We have a guy who we really like. We're going to make him CTO and give him some equity. Fine, we can do that. But ultimately, my thesis is that the team, the product, the market, and the vision are absolutely critical here into actually getting that first angel and / pre-seed check. Then when you're in this stage, in the pre-seed to seed stage, and this is, again, where most angels will come in, the goal should be to grow, to get to a point where seed investors are going to be like, oh, okay, this is something that we want to put money into, right? So this could be any sort of metric. So for quite a few apps, it would be just users. So there's a SaaS company that I've seen present before at BAN where they were charging for the product. And my first feedback was just give it away for free. That's it. Like just the fact that people will even use it shows that there's demand for it, right? That's actually all that matters at that point. Because if it works and you get, let's say, 10,000 users on the app, that's an indication that there is some level of product market fit. And then you can start iterating. So then that founder can go to a VC like us and say, hey, look, we got 10,000 users. We've done very minimal marketing. We haven't built a team out, but we know people are actually interested. And then the next step can be, okay, we're going to go raise some seed funding, more angels can participate. And that's where it makes sense for them to actually say, okay, we need to actually make sure the users are coming back. At C to Series A, users coming back matters because when they're coming back, that means there's a stickiness factor. The stickiness factor is where you can then say, okay, we need to charge them maybe, or we can do X or Y type of revenue platform. And as you get towards Series A, Series B, that's when revenue becomes a priority. Now, if you notice, one thing I have here is revenue priority is medium at C to Series A, and that it's minimum in angel to seed. It doesn't mean you don't make revenue. It just means that shouldn't be the focus, right? And you'll notice profitability is not until I get to post Series A. So in the back of their minds, founders need to keep profitability as they go past Series A, but not until Series C, which is where we're starting in growth stage, that profitability actually really matters. Now, why does it matter at that point? C, D, and subsequent rounds are basically growth equity rounds. Growth equity is where it's not just early stage funds that are coming in, but corporate venture, private equity, hedge funds, right? Because what's happening is for a lot of funds like, let's say, KKR or Warburg Pincus, right? A lot of the big private equity funds around the world, what they're realizing is the value that they want in the public markets isn't present. So they're going to companies that are going to IPO probably in the next 3 to 5 years. That's where growth equity comes in. So when they're doing that, their mentality is, okay, we need to start showing better fundamentals. Those fundamentals tend to be revenue, margins, profitability, or a path to profitability. And that's why, this is not a one size fits all, but it's a relatively generalized, and I think a relatively accurate indication of how progression should occur. again, I'll stress one of the issues that I see all the time is we ask often for Series A, Series B things from an angel stage company in Bangladesh. We can't do that because what that is doing, if a founder comes to me, and I get this all the time, I had a really smart founder come to me about a month ago with a product I really, really liked. And in the deck, they said, hey, and we're going to be break even by May 2023. And I'm like, if you're going to be break even by May 2023, why do you need venture money? You can just go take a loan from a bank or a friend or something because you clearly are going to be profitable. Then you can just fund your business with cash flows. My goal as a venture guy is to make sure that you can go and become $1 billion company. But for that, that means that every dollar you make should go back into the business. You should not be net profitable. Now, gross margin profitability is fine, but net profitability should not be something anybody at this stage thinks about. In Bangladesh, we have, frankly, I don't think we really have any companies that are at that stage, maybe with the exception of Bcash, right? Other than Bcash, nobody's really focused on Series C plus metrics in growth equity and profitability. I mean, ShopUp is getting closer there, and I think Bata is getting closer there, but mostly it hasn't happened because when you look at Bangladesh, right, and look at the growth rate of the country, you look at the middle class rising as it is, the opportunity is so early that it would be naive, frankly, to ask for mature stage metrics from these founders. The other thing that I really like when I talk to a lot of angels, I say is like, what are you good at? What value can you really add? I think as an angel, it's important to actually ask yourself that question, right? So for instance, there is an angel in a company that we're looking at right now, whose job is go-to-market strategy. Like he's spent 5 years doing go-to-market strategy where he's taking freemium models and turned it into paid models. That is a skill set that is incredibly valuable to a founder. Right. So as that angel works with that founder, we know that whatever money that they gave to the founder matters. So yeah, I always say like, think about what skill set you're best at and then try to find a company where you know you're going to add the most.
In terms of, the structural or, the regulatory impediments that we have to create like, a list of angels or pull them in under an SPV, which is not common, and an instrument like SAFE, which is not, common in Bangladesh. How do we sort of standardize the market expectations for international VCs as well as Bangladeshi angels?
The thing that is most important. So, if I'm looking at a seed round investment, which we've done 5 seed round investments, we're doing 2 more, and we've done 1 pre-series A investment so far, and we are looking into pre-seed increasingly. For the seed round, we like to have a clean cap table. Right. So first thing we look for is we want to make sure that the founders have, say, 70% plus ownership. Ideal is closer to 80, but 70 to 80 is a good number. So we want to make sure that the founders are still incentivized to lead the company through multiple rounds of funding. If I come in at the seed round, I probably expect another 3 rounds of funding before I have an exit at the very least. So if you average 15% or 15 to 20% dilution at every one of those rounds, if the founders have below 50% at that point, it's almost impossible that we're going to do that deal. It doesn't make sense, right? So that's important. The other thing is we don't want 700 angels on there, right? Like that's just messy at that point. So that's where it's nice to have an SPV where it's like one clean line item. And then we also here's the thing, you can have 10 angels. That's actually not an issue. The thing that we want to be cognizant of with our founders is we want founders to spend time building. We don't want founders taking time to just answer emails to investors who a long time ago gave $5,000. And I say that respectfully in the sense that a founder has a limited time during the day. They should be focused on building. They should not be focused on, questions about an investment that was made a while back. So this is where investor relations for founders comes into play. I think we as a community are getting better and better at founder relations or investor relations, but that needs to be something that is embedded in all the founders more effectively. Yeah, I think your goal is to make it as seamless as possible. So for instance, Jawad, if somebody has board control, we've seen this before where there's 2 board seats from external angels and 2 board seats from founders. So I'm like, why do I want to deal with 2 local board seats where they allocated $100,000 when I'm going to put in $1 million, right? Things like that are problematic because if you think that company is going to end up raising 50 million, again, I don't want to deal with a board member who doesn't have international experience, will potentially disagree all the time, etc. Now, I say this again respectfully from an angel perspective. As an angel, you should be doing what increases the chances of success for the startup. Period. Right. That means being cognizant of how the successive rounds will actually occur. And if we are able to do that, if we are able to structure deals appropriately, it really does change the game. The other thing that I should note is, and this is something that we're working with the government on right now, is for having the holdco being in Singapore or Delaware. Because 95% of funding historically has come from international, they are not going to invest locally in a Bangladeshi holding company or Bangladeshi company. Why? This is actually a global thing. This is not just Bangladesh. So like Y Combinator, for instance, will only invest in companies in 4 countries: Singapore, Delaware, or US, sorry, not necessarily Delaware, Singapore, US, Canada, and Cayman Islands. That's it, right? So Indian startups, Indonesian startups, Vietnamese startups, they're all generally based out of Delaware or Singapore, right? The main reason that happens is not actually repatriation, which is a very common misconception. I would say 75% of the reason is actually the legal framework. So in Singapore, for instance, a safe note, a convertible, convertible debt, or all these instruments are actually fully recognized. So if something happens from an investor, between an investor or founder, they have legal recourse. On the flip side, so for instance, we have a company in our portfolio called Alice, which is a SaaS company with majority international clientele. So if I'm a US client and I sign a contract with a SaaS company, I want that SaaS company to be in a jurisdiction where if anything goes wrong, I can take them to court. If that company is fully based out of Bangladesh, I may not have the legal recourse that I am expecting. So jurisdiction matters, and this is something that needs to get more and more cleaned up over time. Pakistan changed the jurisdiction rules to be more favorable last year, and their fundraising went up from 50 to 350 million in a year. That was not a coincidence. And I think the same thing can happen in Bangladesh if these changes occur. And I feel positive that we will go towards that in the next year.